Well, thank you, Jason, and thank you, Maya, for inviting me. Um, I've given lots of talks all over the world. I think this is the first time I've ever given a remote talk. I do teach a class remotely at the University of Washington, but this is the first time I've ever talked to a live audience kind of as a presentation. So hopefully this all goes smoothly, and I hope that we can get started.
Awesome, thanks, Mike.
So we're going to talk a little bit today about developing and backtesting systematic trading strategies using R, specifically using R. I don't usually introduce myself, but Jason asked me to give a little bit of an introduction, and I suppose some of you are wondering who I am anyway. And I'm also going to talk a little bit about proprietary trading or principal trading because a number of people seem to be a little not sure about how proprietary trading is different from other types of trading. So I am a quant, an author, and an open source advocate. As Jason mentioned, I'm author or co-author of over 10 packages for using R in finance. I think I should say a little bit about that specifically, since this is an R user group. We give away all of our non-proprietary infrastructure. R is our predominant research environment. Almost all of our research is done in R. We use a little Python for gluing things together. But really all of our research leading to production trades is done in R. And almost all of that, from an infrastructure perspective, anything that's not proprietary, we release as open source code. So one of the things that I think is really important is that we release that code because of the leverage effect. Because we get benefit and collaboration from other people in the R community. One of my co-authors says beer is currency, and many of the other authors of these R finance packages are only a beer away from a question. So, you know, just having our stuff out there in the public means that we can collaborate with people we otherwise wouldn't really be able to talk to. Many of the other R finance package authors work at my competitors, places like Citadel or Hull Trading, other big firms. Many of our packages are used at some of the world's largest asset managers. And by putting them out into open source, at the very least, somebody will tell me about my bugs much, much sooner. I firmly believe that all code has bugs, and you know, having people tell me about them up front is really valuable. I'm also the organization administrator for R's participation in a program called Google Summer of Code. If you've never heard of it before, do go look it up. It's a program where Google pays students, mostly graduate students in R's case, but also undergraduates, to spend the summer writing, or the Northern Hemisphere summer. I'm talking to you guys halfway around the world, but to spend the Northern Hemisphere summer writing open source code. I teach a class at the University of Washington in the computational finance and risk management, and I'm a partner at DV Trading. And then just briefly, what is proprietary trading? DV is a proprietary trading firm. We have no customers. Proprietary trading in the United States and Europe is, in fact, not allowed to have customers. All of the money that we trade is either the firm's money or the money of the partners of the firm. In almost every market that we touch, I look like a market maker. I am a market maker. I'm a registered market maker in many markets, and I look like a market maker in other markets. So fundamentally, what we do is provide liquidity in markets all over the world. And we use R to do the research for that and other systems to do production. So with that, on to the meat of the talk here. Oops. So one of the things that I wanted to talk about is how R fits into the, in this case, the trade simulation tool chain and the trade simulation workflow, but also more generally in terms of kind of some of the activities that you might engage in. So if you think about the types of things that you need to do when you're doing quantitative research, you know, you need to start by managing data, evaluating the data, determining the trades, sizing the trades. After you've done the trade, you need to calculate the performance and analyze that performance. So So in the kind of center of the slide there, you can see a whole bunch of different activities that you might undergo to do those things. Well, the fact is that R can fit into this tool chain or workflow in all sorts of different places, all the way across the workflow. There are examples of packages under here. There's a few I probably left off. The RTAC package was recently renamed to high frequency. RCPP is not on here, although it gets used a lot to speed up other packages. You know, many packages in R at this point will use C++ or C in the back end. But R can be integrated into almost every stage of the trading or quantitative finance workflow and tool chain. So the primary topic I was asked to talk about today was backtesting in R. I'll mention R packages all the way through, but because I'm giving a talk halfway around the world and because we only have 40 minutes or so to talk if we're going to have time for questions, I'm not going to show a lot of code. I will mention R packages and R functions that generate all of the graphs and charts and things that we go through. But I'll start with two quotes. I'll let you read them. But they demonstrate two very different points of view about backtesting. Josh Diedish is a portfolio manager at one of the largest pension funds in the United States. It's the California State Teachers Retirement System. And Emilio Tomasini has written a book on trading system optimization. I think they're both right. I think on the one hand, no one ever shares a backtest that fails. And on the other hand, every trading system that goes into production has been optimized to one degree or another. So the question is, how do we reconcile these two views? How do we, on the one hand, do a better job of backtesting, and on the other hand, realize that, that almost all backtests will fail? Inside my team, I say that 90% of all of our brilliant ideas will fail. So what I'm going to advocate here and talk about is really a application of the scientific method to backtesting and how we can integrate R into that process. So the first thing I think we need to do is we need to move beyond a set of assumptions. I've heard the statement more times than I could count when asked for a hypothesis. Well, I hypothesize this strategy or this strategy idea will make money. Well, that's not really a hypothesis, and it's not really scientific. So what we're going to try to do here is we're going to try to describe how we can integrate our business constraints and objectives, build strong hypotheses, put everything together in pieces, test those pieces, and give up or back up before we get to the end, and then measure how likely it is that when we get to the end of this, we've overfit everything. So I always start with understanding your constraints and objectives. It's very easy when doing quantitative research to lose sight of this fact. But the fact is that any real investment plan has constraints such as capital available, what you can trade, how you're going to execute it, what your structure is to the market. You have some benchmarks. I don't have customers, so I measure myself against benchmarks that we construct. But anyone who has customers, you know, has a investment committee, they have management, they have investors, and you have to really understand that you're going to measure yourself against certain objectives as well. So what I'll say about objectives, and we'll talk more about it as we go along, is that objectives should be formulated in ways that are testable. Are we actually meeting our objectives, and how do we know if that's true? And make sure that objectives reflect your business goals. So the reason that I start here with constraints and objectives is that I've seen many, many backtests presented to me by people who couldn't possibly trade the system that they've put in front of me. They don't have the systems, they don't have the capital, they don't have the mandate to trade that system. So even if the backtest is good, and it most likely isn't good, it's designed for the wrong environment. So I think you need to understand your environment right up front. Another thing, for all the scientists in the room, I'll apologize for a review, but we want to start from a testable idea, which is a hypothesis. So we want it to be declarative. We want to make sure that our conjecture is predictive. We want to define its expected outcome. And we want to describe how we're going to verify or test it. You know, I always had trouble when I was in school with the null hypothesis, with, you know, what is the null hypothesis anyway, and how do we define the null hypothesis? In trading, I think it's very simple. I want my hypotheses to be identified not in ways that would confirm the hypothesis, but in ways that would refute the hypothesis. So I want to test things such that I can identify facts or outcomes that would tell me that my hypothesis is wrong, that it's junk. Almost all of our hypotheses are going to be junk. So, you know, one of the things we want to think about when we talk about this is we want to think about, you know, what are we analyzing? What are the results or predictions? What are the inputs to that model? And what are its anticipated outcomes? Really focusing on how we would refute the hypothesis. Because almost all of our ideas are going to be wrong. Almost all of the things we're going to try will be wrong. And we want to avoid overfitting from this very, very first step. So from the very beginning, we want to say, if I find this certain thing or these facts or these outcomes in my testing, I want to throw the whole thing out. I want to go back to the beginning and start over. Because it's very, very easy to overfit. One of the favorite games among quants that I know is to take random inputs and turn it into a trading strategy that can make money. Obviously, that's an overfit strategy, but it can be done. We want to try to avoid that from the very, very beginning. So to do that, let's introduce a framework that we'll talk about through the next little while here as we go along. We're going to talk about building blocks here. Filters are the instruments you're going to trade. They might categorize market characteristics that are favorable to strategy. We're not going to spend a lot of time on those, but some strategies are almost entirely filter-based. For instance, if you have a strategy that invests in large cap European stocks, you're filtering for large cap European stocks. Indicators are quantitative values that are derived from usually from market data. They include all the common technical indicators or technical trading rules. They typically measure something. Think about indicators as measuring something. The next building block is signals. Signals take those measurements, maybe combine them with other measurements, maybe combine them with the filters, maybe combine them with the market data itself, and they make a prediction. So a signal is a point in time at which you are predicting something, and at which point you may want to do something. Not that you necessarily will do something. In a simple strategy, signals and rules may be identical, but in most strategies, signals are just a point in time at which you may want to actually take action. And the final building block we'll talk about is rules. Rules make path-dependent actionable decisions. The path-dependent part here is really critical. A rule takes a signal or a group of signals and makes a decision based on the current state. So in the lack of anything else, again, in a very simple strategy, every signal may equate to one rule and may equate to a trade. But in the real world, that doesn't usually work that way. In the real world, we have other constraints. Things are path dependent. If I have my maximum position on, I can't add more. If my risk is too high, I can't add more, or I may need to take action to take the strategy, take the position down. So rules are path dependent. Now in R, this is really important because my filters, indicators, and signals can be done in a vectorized fashion. In R, taking vectorized decisions goes much, much faster than taking path-dependent decisions. So the filters, indicators, and signals are all processed in one pass, and then the rules have to be processed in a path-dependent way. And by the way, this building blocks model is the model that's defined in the R package QuantStrat. You'll see a lot of references to QuantStrat as we go through here. It's a package that we developed for our own internal research that is focused on signal-driven strategies. There are other types of strategies, of course, but for signal-driven strategies, QuantStrat was designed to automate a lot of the workflow steps. Another thing we're going to talk about is how we can test the system in pieces. I kind of define this as how to screw up less. John Tukey, who is one of the top statisticians of the 20th century, described that he would prefer an approximate answer to the correct question than an exact answer to the wrong question, because of course it's easy to find an exact answer or a more precise answer than the input data would allow you to have. And on the other end, one of the most prominent physicists of the 20th century, Richard Feynman, points out that no matter how beautiful the theory, if it disagrees with experiment, it's wrong. So what we're going to try to do here is define a set of experiments and demonstrate whether our theory is correct, and also put together our questions in a way that gives us a directionally correct answer. So many things that we can do wrong in this process. These kind of define types of biases in the data forecasting world, but also define types of overfitting. And they very commonly show up in backtesting. Look-ahead bias is directly using future knowledge. Data mining bias we'll spend more time on as we go through the talk here, but is really caused by testing multiple configurations and parameters over multiple runs. So you do something, it fails, you stop, you back up, you start over. Exhaustive searches over the data may or may not also introduce data mining biases. Data snooping is specifically knowledge of the data set, or so knowing about the data. Now, we have a problem here. I've been in this industry for almost 20 years, 15 years at least. So of course I know that there was a financial crisis in the 90s, and there was another one at the beginning of 2001 when the dot-com bubble burst, and there was another one in 2008 when real estate and the financial crisis happened. So on the one hand, I can't work around that. I've been doing this for a long time. Anyone knowledgeable in the industry is going to have some knowledge of these things. But the biggest thing that causes data snooping biases is to fail at something that you're trying to do research in or backtesting in, and then go back and make changes without having a strong experimental design. In the sciences, this is called ad hoc hypotheses, and we want to avoid making hypotheses after something has failed by trying to make up an explanation about why that might be true or might not be true. So we're going to try to remember these biases and come back to them as it makes sense along the way. So again, to go back again to what indicators are, they're measurements of something. So they might be a fair value price or a theoretical price. They might be an impact of a factor on the market price. They might be turning points, direction, slope of the series. So even before I have anything else done with a backtest, I don't want to jump to the end of a backtest. I don't want to jump to the equity curve at the end of the backtest and say, did the strategy make money? What I want to do is I want to say, you know, what's the hypothesis for the indicator? What does it measure? How do I know whether it has a good fit? Are there t-tests or p-values that I can apply to it? If I have an understanding of what it is I'm trying to measure, I might be able to construct a custom perfect foresight model using the periodogram or using the signature plot of the original data. And I want to ask myself right up front, before I stick measurements or indicators into a backtest, whether the indicator has testable information. If it doesn't have testable information, I need to either construct tests or I need to throw out the indicator and start over. Before I step forward and say, well, here are my signal process, and here are my rules, and here's the overall backtest, I want to say, if I can't test the indicator, does the indicator actually measure what I think it measures, I should stop. And again, we're trying to avoid overfitting at the end of the process by starting very upfront, very early at the process and saying, can I actually measure the market phenomenon that I think I can measure? I'm trying to avoid making mistakes later in the process. Now, once I've constructed a signal process, my signals all make predictions. So because I'm making a prediction, I'm making a forecast. Because I'm making a forecast, I can use everything from the forecasting literature. I can use mean squared forecast error. I can use the Bayesian information criterion. I can use box plots or additive models of my forward expectations. I can use models like the Racine and Parmenter revealed performance model, which is effectively a data partitioning and resampling model that lets me resample my returns. I want to reevaluate the assumptions about the method of action of the strategy and detect information bias or luck before I move on. The plot on the other side of this slide here actually takes a series of signals at time 0 and then looks forward in time to see what the distribution of outcomes is based on those signals. So every signal makes a directional prediction. We're going to assume, because the the regression line in this model is upward sloping, that these were predictions of an upward sloping outcome, of a directional bias for a long bias. So this is generated in an interesting way. It takes the signals out of a backtest or out of real returns. So another way to use this type of plot is to take your actual trades and use it for post-trade analysis. So if you buy or sell, you're making a prediction that the price is either going to go up or go down. So you can now take this and you can look forward in time. If time 0 is the time of the signal or the time of the trade, each period forward is an observation of whether or not you were correct. And this was generated, you can see all through here, I don't know if you can see my mouse, but all through the presentation, when I highlight something, these charts will have the package and the function that generated the data. And this is the distributional box plot from QuantStrat. So hopefully by this point we have an indicator or indicators that measure something, and we can demonstrate that they correctly measure what we were trying to measure. And we have a signal process that we've also measured and says the signal process is predictive. Now, note that I haven't said anything about a full backtest yet, because we don't have a full backtest yet. We only have an indicator or indicators that measure something, and we have signals that make a prediction. If our signal process doesn't have predictive power, we should stop. We should back up. We should, go back to the drawing board, say our original hypothesis was wrong. We need to come up with something that measures things better, and we should be able to test that, or we should need to come up with a signal process that actually has predictive power. We don't want to jump to the end of a backtest and run the entire backtest and then say, oh, it makes money. Well, why does it make money? I don't know. I'm going to guess. So now we get to rules. Rules should define the way the strategy listens to signals. Remember that I said that rules are path dependent. So one of the things that we should think about is that we should think about how we want to respond to different signal processes. Many simple strategies use a set of symmetric rules where entries and exits use the same rules. Many more complex or real strategies use different signal processes for exiting, or different signal processes for risk, or different measurements for risk than they do for the entries. Now, one of the things that I see in a lot of the trading literature that I want to highlight as a real danger point is what I call rule burden. Much of the trading literature suggests first adding your entries and then seeing how those work, and then going back and adding exits and seeing how those work, and then going back and adding risk rules and seeing how those work. This will absolutely create a backtest that has increasing performance as you add more rules. However, it should be obvious that one of the things that you're doing here is you're really inviting overfitting. So if you're adding rules after you're disappointed in your initial results, you are very often adding rules because of data snooping. You now understand better how the strategy is working, so you're adding rules to try to not make those problems. So strategies with fewer rules are more likely to be robust out of sample, or more likely to be robust in production. Another thing that you often want to do is you want to optimize over parameters. So a couple of interesting things that you want to think about is you want to think about the stable region of those parameters. The plot on the left-hand side has a stable region up in the top where the parameters change, and eventually the P&L basically stabilizes. One of the things that I see often done in backtesting is that people brute force a giant range of parameters, where you have a huge range of parameters that you brute force over. This is really, really dangerous because, again, it's an exercise in overfitting. So what I would suggest instead is think about the parameters you have. How many of those parameters can be fixed because of the model? So you have a model input, and you're going to fit your model, and you're then going to fix those parameters as parameters of the model. And how many of the parameters need to be varying, and are they time varying? Are they varying because of some other input? And you should try to limit the range over which you do parameter optimization to a range in which you have a strong economic basis for believing that the parameters can be that way. A good example of this is regime switching models. So I can easily hypothesize that markets go through volatility regimes, that I may have a regime switching model that can detect the volatility regime, and that therefore in a high volatility versus a low volatility environment, the parameters for my trading strategy might be different. And that's a reasonable hypothesis. It's a testable hypothesis. You can test for the existence of those volatility regimes. You can test for the behavior of the strategy in the different volatility regimes. And then you can have a strong theoretical basis why you might have different parameters in a high volatility regime versus a low volatility regime. Let's separate that from a different model where you don't have a hypothesis. You simply say, oh, well, you know, my input can vary from 0 to 100, and I have 5 parameters that all have varying inputs. So I'm just going to test them all and choose the best one. Well, in this second example, we've almost certainly overfit our data, and we are inviting bad performance out of sample. One of the ways to avoid some of the overfitting and out of sample problems are to use walk forward analysis. We can have both rolling and anchored walk forwards. A rolling walk forward uses a fixed in-sample period and then has an out-of-sample period, and then it steps forward and uses the same in-sample period, you know, on a trailing basis to then create a new out-of-sample period. An anchored walk forward uses all the data from the beginning of time and then has an out-of-sample period to do these things. Quantstrat supports walk forward analysis, both rolling and anchored in the walk forward function. One of the things that I'll say about anchored walk forward is that anchored walk forward makes a lot of sense for risk metrics and very little sense for most indicators. Most indicators have a built-in look back period. So you end up with a rolling walk forward window anyway. So walk forward can be combined with parameter analysis. The chart on the right-hand side is a combination of a walk forward chart with the optimal set of parameters, as well as in the gray in the background, a set of walk forward outputs with different parameters. So what's happening is that you're doing parameter optimization in each of the in-sample periods, and those become the gray background, and then the blue is all out of sample with the optimized parameters. Now, as one would expect, you see that it's in the upper range of the performance, which suggests that you had a reasonably good objective function. In this case, I think the objective function was max Sharpe ratio, but it's not at the top because, you know, some lucky breaks could put you at the higher level, or some slightly better parameter choice could put you at a higher level. And one of the things, because this was optimized on Sharpe ratio, note that it has a good risk-adjusted performance. Many of almost all of the gray samples on the right-hand side have a lower performance on the risk panel at the bottom, which is the drawdown panel at the bottom of the walk forward analysis chart. So walk forward analysis tries to avoid certain types of overfitting by saying, well, the near future is likely to resemble the recent past. So it allows us to say that we can optimize and in fact data fit, you know, fit our model, you know, fit our whole trading strategy to the recent past, but then leave those parameters fixed over the out of sample period before we redo our parameterization. One of the dangers that I'll talk about with regard to walk forward analysis is that you don't want to do it too often. You want to wait until near the end of the strategy development process, once you've got a pretty good idea that your indicators measure what you think they measure, that your signals are actually predictive, that you aren't overdoing your parameterization, and then you want to do walk forward analysis at the end to do parameter optimization. If you go back and redo walk forward analysis and redo walk forward analysis and redo it after you've added rules, you're almost certainly overfitting. So you want to be very careful to not do walk forward analysis too many times and only do it kind of at the end of things. Once we're all done, we want to measure the whole system. Robert Pardo has a well-regarded book on trading system development, and he says that net profit as a sole evaluation method ignores many of the characteristics that you want. You want a smooth equity curve, you want an upward sloping equity curve, you want a number of things. The chart here is from the chart.mae, which is maximum adverse or maximum favorable excursion, which looks how far a trade moves for or against you before it's closed. It's not a very common chart, but I think it's a very useful one. In this case, we're looking at how far a trade moves against you before you close the trade. So the red dots are trades that close at a loss, and the green dots are trades that close at a gain. How far the trade moves to the right of the chart shows how much of a drawdown the trade takes before it's taken off. Trades that are on the vertical line at the far left of the chart are trades that close on their highs. And trades that, the red trades, or green trades for that matter, but trades that close on the diagonal line that goes across the chart are trades that close on their lows. So it's an interesting way to think about your performance, and it's a very useful way to look at real trades. So trades that actually happen in production. I would say that the blotter package in R is probably used as often in the real world for post-trade analysis of real production trades as it is in backtests. Because you can take your real production trades and look at them in some of the same ways that you would slice and dice trades that were simulated in a backtest. Of course, you want trade statistics on either real trades or backtested trades. You want this whole suite of trade statistics. Number of trades, means and medians, percentages of positive and negative, profit factors, drawdowns, win-loss ratios, the adverse or favorable excursions that we just got done talking about. One of the things to be aware of is that aggregate statistics, just looking at the equity curve or at the daily returns or the monthly returns, depending on your trading horizon, can be very dangerous. They hide a lot of the most common outcomes. They focus on the extremes. You might not have enough trades or history for validity. You might have collinearities if you have overlapping round turn trades. But we've provided a bunch of tools for analyzing either simulated or real trades in the blotter package with trade stats and per trade stats. That was all cash P&L. What about returns? What about percent returns? Percent returns create a standard mechanism for comparing multiple strategies or managers. Your choice of the denominator matters. The paper that's linked to this talk talks about choosing the denominator, because choosing the denominator actually matters a lot. But when you're in return space, you get access to all the econometrics and risk literature. So a bunch of literature that wasn't otherwise available now becomes available to you around tail risk measures, around volatility analysis, around factors, styles. You can compare strategies in return space that you can't necessarily compare in cash P&L space. And there's a long applicability to asset allocation here. If you have multiple systems, you can talk about asset allocation. Or if you have a single system, you can talk about trade sizing. We tend to do asset allocation only after the strategies are in production. I'm always suspicious of backtests that do trade sizing in the backtest, because it's a very common way of overfitting things. When we do backtests usually on one lots or minimum tradable sizes. And our initial scaling is done in production and on an ad hoc basis, because we test the strategy in a tiny way in production first to make sure that it agrees with the backtest, and then we scale it slowly and ad hoc to just see how the market responds as we adjust our sizes. Eventually, when a strategy is running kind of at capacity or at a size that we feel comfortable with, then we can take out returns, usually using daily returns and not intraday returns, become returns of a synthetic asset, the strategy, or just like you would do, the strategy becomes like a fund that you would put into a portfolio optimizer. As inputs to the optimization. The optimizer should use your business objectives as the portfolio objectives. So it should be able to tie way back to the very beginning of the talk where we say, well, what were our business objectives? So the portfolio analytics package in R is used extensively by traditional asset managers covering tens of billions of dollars of assets. In fact, some of the world's largest asset managers and pension funds. But it was originally developed to optimize capital allocation for trading strategies at a trading firm. So all of these traditional asset allocation tools can be utilized for trading strategies as well. And we're in fact designed to do that from day one. So we've got a backtest, now what? How do we detect whether or not we overfit it? One of the things that comes out is that, just trying and trying and trying is likely to result in a positive back test just by sheer luck. So there are a bunch of tools that we can use to test these things. I'm not going to go into great detail about all these things. I think we're running a little low on time. But I'll mention them quickly. White's reality check looks at how we might discount the how likely is it the results of the back test are the subject of chance. K-fold or CSCV sampling takes samples out of the data, run the test multiple times over different samples of the data, and see how robust the results are to those tests. Multiple hypothesis testing tries to look at whether we are creating type 1 or type 2 errors, which are the likelihood that we have accidental or we're ignoring positive results, or we're getting erroneous positive results out of our testing. And then we evaluate what appropriate haircuts might be based on the probabilities that we've created certain types of errors. There are haircut models for sharp ratios based on how many times we've run the back test. Remember, I said that we shouldn't just go back to the beginning and start over and go back to the beginning and start over unless we have a strong experimental design. There are statistical ways of discounting the results to say, given how many times we've tried, we're more and more likely to be overfitting our data. Another way of looking at our results is to use Monte Carlo analysis in the bootstrap. So we want to try to estimate the true properties of a distribution from some incomplete information. We want to evaluate the likelihood or test the hypothesis that a particular result is that is due to luck, that it's not due to chance, that it's not overfit. We want to understand our confidence intervals for other descriptive statistics on the back test, and we want to simulate different paths that results might have taken if the ordering has been different. Jasen, Mackie, who's in the room there with you, has been doing excellent work in Blotter on a function called MCSIM and its related plot and histogram methods to add this functionality as a standardized set of analyses in Blotter. I'm going to talk a little bit about the history of Monte Carlo in the bootstrap, just because I think it's really interesting. So this came out of core statistics. Laplace was the first to describe the mathematical properties of sampling from a distribution. Mahalanobis of the Mahalanobis distance extended this work in the 1930s to describe sampling from dependent distributions, which in the case of backtesting, we're almost always talking about dependent distributions between the different symbols or instruments in the backtest. And he anticipated the block bootstrap by examining these dependencies. What we now call Monte Carlo simulation was developed by Francois Ulam and John von Neumann as part of the hydrogen bomb program. So the fastest computer in the world was the ENIAC. A pocket phone is massively more powerful than the ENIAC was. So they decided that instead they had to simulate the paths of the neutrons in the reaction to see what was going to happen. Nicholas Metropolis actually put this into the ENIAC machines, and the Maniac machine, which was the successor to the ENIAC. They named it the Maniac to try to stop people from naming machines. That didn't quite work out. The names just got crazier as the years went on. Metropolis worked on some more things in the 50s. The prior distribution sampler that's now called Metropolis Hastings and is kind of a core part of all Bayesian analysis. John Tukey developed the modern jackknife in the 1950s, and then Bradley Efron described the modern bootstrap in 1979. So I think it's really interesting to see how even when machines were really, really small, or even before these machines existed, this kind of simulation method was used to analyze the likely path or likely outcome of a set of distributions or possible outcomes. So back to backtesting after that little digression into history. So we can simulate over the results of a backtest by taking those backtests and by then using a Monte Carlo bootstrap to see how else it might have come out if the input data had been different or if the daily returns had been different. And we can then, of course, do this simulation and plot it. The plot on the left is simply all of the replicates, with the red one being the actual backtest. The plot on the right is a distribution of the drawdowns of the outcomes. One of the interesting things that we see here is that the backtest itself, the vertical dotted line to the far right of the graph is the backtest drawdown, and the median of all the samples was worse. Now, we would expect our backtest to be kind of close to the top of to be kind of among the best performers of things. However, it's useful to know that the possible performance is much, much worse, that your output can be much, much worse. Now, we can draw certain statistical inferences from that. We're not going to spend a lot of time talking about that as we're running kind of low on time, but it's useful to understand that you have all this data, you can do analysis on this data, and you can come up with, inference based on that data. So I'm going to conclude so that we have time for questions. So I think that one of the things that we need to think about is that all backtesting should be performed in the business context we operate in. What constraints is the business under, both technical and business-wise? What benchmarks are we going to measure the system against? What objectives do we have in terms of our business objectives and objectives for the test? We want to separate all the components of the strategy so that we can identify really early on, both from a productivity perspective and from an overfitting perspective, whether or not this strategy has a chance of working. We want to construct testable hypotheses for each step of the process, evaluate those components separately, and test yourself often, because it's really easy to fool yourself in this business. And we're going to put real money on the line. You really don't, you want to do that in the research stage. You want to make your mistakes in the research stage and not make those mistakes with real money. All of this code and all of these techniques that I touched on briefly are work in progress. Some of the work that we're currently doing is that we, plot.xts was rewritten by one of my colleagues a few years ago, Ross Bennett. You might have seen him crossing behind me in the room here. We're doing work to use that work. Now that that work is basically production ready, we're converting a number of other packages, performance analytics, Blotter, QuantStrat, QuantMod, to use plot.xts. We're using a Google Summer of Code project to do that. The student is Eric Hung. Jasen is working on enhancements to the Monte Carlo analysis. There's much more work to do there. We're going to do additional round-term trade classifications. We're working on more functions for detecting and measuring overfitting. We're implementing a number of the methods that I mentioned in passing earlier. We're going to simulate random trade entry and exit points that meet the constraints of a given strategy. This is really work that was pioneered by Pat Burns in England. I cite him in the longer paper, but I didn't cite him here. And we're going to do additional post-trade analysis and reconciliation functionality. As I said, Blotter is widely used for post-trade analysis of real trades. So even if you're not using Blotter for backtesting, you can punch real trades into it to get a lot of analytical functions around that data. All of this functionality is a community effort. It's developed by many people, not just me. If you want to get involved, please contact me. There's a slide here that you'll all be able to reference later. I'll make the slides available on installing everything. I won't spend time on it, but here's kind of the general process for doing that. And with that, thank you. Thank you for your attention. It was my pleasure to be here, and I'd be happy to take your questions. Oh, and also here at the end, there's a set of bibliographic entries so you can get more detail on a number of the things. The details of this talk are, much too short. There's too much stuff to go through in, 40-minute talk. So there's a link here to a paper that goes into all of these things in more detail. And with that, I think I'd be happy to take questions. Jasen, kind of back to you.
Brian?